Oh, my music is not playing. Why is my music not playing? Why is my music not playing now? Alright, let's do it like this. There we go. Yeah. Alrighty, it's been 2 minutes yet. Yes, it has. Alright, let's get it going. Start my music over. And here we go, ladies and gentlemen. Yo, 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 yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. And I've returned today to whap and tap on your head with more ADH Wealth Solutions articles and, you know, them cash commandments. So one of those commandments is definitely thou shalt not fumble the bag. And that's what we're going to talk about today. You see, we get a lot of people who fumble the bag when it comes to purchasing life insurance. And I see it all too often. But before we get into that, ladies and gentlemen, make sure you hit that like, subscribe, drop a comment, and if you're new, hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, the information is in the description. To purchase life insurance up to $1 million with no medical exam and an instant decision, the information is in the description. To schedule a one-on-one consult, the information is in the description. Now, as we proceed to give you what you need, let's take heed to what we got going. Let's take a look here. We have an article again from one of the companies that I represent, which is Mass Mutual. And here it says, your top 5 mistakes when purchasing life insurance. You see, a lot of people buy life insurance for a death benefit, or if you saw my video on wealth contracts, a lot of people purchase life insurance to protect, preserve, and pass on wealth. So that's what we're going to look at here. And as you can see, those top 5 mistakes is an article by Shelley Gigante, who specializes in personal finance issues. Her work has appeared in a variety of publications and websites. This is an October 15th, 2021 article. And it says here, if you're in the market for life insurance or already have it, you don't need to be told that proper coverage is an important pillar of personal finance, providing much needed protection for those who depend on you. But all the coverage options available and costly errors common, it might just help to explore some of the biggest mistakes people make when purchasing policies of their own. Now, this is going to be very common. It actually breaks down the top 5, and then we'll go deeper into that. So these top 5 mistakes are: 1, waiting too long to buy, which I hear from young people all the time. Well, I'm young, I don't have a wife, I don't have kids, I don't need life insurance. That's actually the best time to get life insurance because it's cheap. 2, getting the wrong type of policy. Well, I heard it's best to buy term and invest the rest. And I have a 50-year life plan, but I'm going to buy a 1-year policy. Relying only on group insurance. I got a job, I got a policy from my job, I don't need life insurance, I'm good. 4, focusing only on the premium. What? You mean I'm paying $60 a month for $100,000 worth of death benefit? I can get more than that somewhere else. Well, you're focusing on the premium. You're not focusing on what the policy can do for you. And 5, being underinsured. I already got life insurance. I got a $50,000 policy. I make $50,000 a year. If I die, my family's good. They'll get $50,000. Yeah, I know. My daughter was just born last year, and I intend on being there till she's 18. But if I die, 1 year of my salary will be sufficient. See how nutty that sounds? When you take a look at that. So now, as we proceed to give you what you need, we're going to read these articles. Read these mistakes. So it says, mistakes happen all the time, said Tav Novelli, a financial professional at Novelli Financial Network in Pittsburgh, Pennsylvania, in an interview. A lot of times, people come to me with preconceived notions about life insurance products that they think they need, but it's not necessarily what's right for them. Waiting too long to buy life insurance. Perhaps the most common mistake when it comes to buying life insurance is waiting too long to buy. Indeed, young people with competing financial priorities often delay the purchase of life insurance until they have kids, which may be in their mid to late 30s. But age is one of the biggest factors that affects the premiums. Generally, the younger you are, the cheaper your insurance will be. So people, when you're like, well, I'll just wait till I'm 40. Imagine if I told you, sir, this year the Space Jam Jordans came out, and I won't let you buy them until 10 years from now. But in order to buy them 10 years from now, you have to allow me to wear them every day and put wear and tear on them, and then come back to you and charge you the same price as I would today when they're brand new and not worn. Well, that's what you're saying when you say, I'll wait to buy life insurance, because you're healthier. You're the healthiest you are today. You will never be as healthy as you are today. And the older you get, the less healthy you get. It's not like you get healthier as you get older. You get health conditions, and just by the sheer fact of wear and tear on your body, you get less health. So, let's take a further look here. By holding out, you also run the risk of developing a serious health condition before you buy, which would render your future premiums far more expensive or leave you uninsurable. For example, myself, I sell life insurance and I don't have it. And it's not because I don't want it, it's because the company will not insure me. The companies tell me, yeah, Mr. Hall, we've looked into your health profile. We look at your blood, your urine. We see that you're a tobacco user. We see that you have diabetes with onset before the age of 50. We see you were overweight. We see you have pancreatitis. We see you have high blood pressure. Nah, we're not willing to risk our money for your half-dead ass. If you got it 10 years ago, maybe we would have thought about it. But you were too young at the time. You said, I'm Superman. I'll wait till I'm older. And now I can't be a responsible man and take care of my vows to my wife, telling her I love you so much that I will protect you from beyond the grave through life insurance. I lied to my wife in my vows. Not intentionally, but being an asshole thinking I had time to wait. And I didn't. But so let's continue. By holding out, you also run the risk of developing a serious health condition before you buy, which will render future premiums far more expensive or leave you uninsurable. The cost of insurance is a common excuse because everything else in our lives seems more important at the time. But successful people buy life insurance. Bottom line, said Novelli. They buy term insurance for their families when they're 30 or 40, and then they buy more, usually permanent insurance. You see, I didn't say whole, I said permanent, because that's what it is. So you get advertised to by your Primerica agent or your financial advisor who doesn't want you to know that they get $833 a month from you. And they'll say, well, look at these insurance agents. What about the commissions? Sue Zorman's good for that. These insurance agents get 90% commission, so I get 90% of $50 a month. What is that, $40 a month? She gets $833 a month in her 2 and 20 fees. You just don't see it come out of your portfolio of your investments. But when you do your investments with Charles Schwab, you're paying $833 a month. You just don't know it. So they usually buy more insurance when they're 50 or 60 because that can be leveraged to meet other financial goals. A term life insurance policy, he noted, is often more affordable than many customers think. When asked how much a $250,000 term life policy would cost annually for a healthy, non-smoking 30-year-old, over half the respondents said $500 per year or more, greater than twice the actual cost, according to Life Happens, a nonprofit consumer education group funded by the financial services industry. Consumers who are aged 37 years or younger guessed even higher, with the majority estimating more than $500 annually and 42% suggesting it would cost at least $1,000 per year. The actual cost of that policy is about $160 per year, or $13 a month. Again, that is probably, now, see, when they tell you stuff like this is my issue with the industry. Because what they're telling you is partially untrue. So when they say that a $250,000 policy for a 37-year-old for a 30-year-old non-smoking healthy male, that is usually a short term. So that's usually a 10-year term because the term gets more expensive the longer you keep it. So you're looking at generally a 10-year term, which is rated at like what's called preferred plus, meaning you never went to the doctor. You're Superman. If you have any kind of regular health, you're not going to get that cheap of a price. But it's great to reel you in and say, hey, $13 a month. And this is why people make the mistake of buying based on price. So 2, the They buy the wrong policy type. What do I mean when I say they buy the wrong policy type? Both term and permanent life insurance can protect your family from financial risk, but they are very different tools. If you pick the wrong policy, and many people do, you could leave your family vulnerable when they need protection the most. Pause before we go further there, because see, I don't really care whether it's term or permanent. I care that you're protected. See, a lot of people will say, ask me this question: what's the best policy to have, Alonzo? Should I get term? Should I get permanent? Or should I get whole life? Should I get universal? There's all these types of policy. What's the best type of policy to have? The absolute answer to that, the best policy to have is a policy that's in force at the time the event occurs. So whatever policy it is, I promise you, God forbid, you got hit by a bus last night and you had a 30-year term $1 million policy, and then I go to the funeral and give your family a check for $1 million, they're not going to say, whoa, Alonzo, was this check for $1 million a 10-year term, or was this check for $1 million a whole life policy? They're just going to say, hey, Alonzo, thanks for delivering this check from my dad. They're not going to ask what type. So the best policy to have is a policy, regardless of the type of policy it is. Now, to make an informed decision, you first need the facts. Term life policies provide coverage for a fixed period of time, often 10 or 20 years, up to 30 years. The most common is a 20-year policy. Because there is no cash value accrual, they're generally far less expensive than permanent policies. If you die before the term expires, your beneficiaries get a death benefit, generally tax-free. If you outlive your term, most policies will allow you to continue coverage, albeit at substantially higher premiums. So then there's permanent life insurance. On the other hand, such as whole life or universal life, and they guarantee a death benefit to your heirs when you die, as long as you make your required premium payments. As such, they can be a valuable estate planning tool. They also have the potential to build cash value that can be accessed during the policy owner's lifetime to supplement retirement income, pay for college tuition, or any other reason. Keep in mind that tapping into the cash value of a permanent life insurance policy can reduce the future death benefit and increases the chance the policy will lapse, which may trigger a taxable event. Young families with a significant financial risk, like a new mortgage, kids to educate, a dependent spouse, often opt for a low-cost term life policy to maximize their safety net, said Novelli. In many cases, a convertible term life insurance policy that allows the policyholder to convert to permanent coverage at a future date as their income allows can be the most flexible, cost-effective solution, he said. And if you go to lifehappens.org, they have financial calculators. Generally, convertible term policies do not require policy owners to submit to a medical exam, which may be an added benefit if they develop a health condition after they buy the policy, but before the window closes. 3. Having group-only life insurance. Portfolio bros in the building, salute, what's going on? My people's in the building. We got it going. So, many employers offer group life insurance as part of their benefits package, which delivers an added layer of financial protection. But for most employees, it's not enough, said Cynthia Richard Donald, a financial professional in Charlotte, North Carolina, in an interview. Having group insurance with your employer and not having a standalone policy or for yourself is a big mistake, she said. It may not be enough coverage, and most often is not portable, meaning when you leave your employer, you don't take it with you. By the time you leave your job, you may be years older and potentially less healthy, making it far more difficult to get affordable coverage on your own. Also, group insurance is also often more expensive, and the cost tends to increase as you get older. A lot of people have hundreds of thousands of dollars worth of coverage in group life insurance, but they have nothing when they leave, said Richards Donald. And this I see way too often. So 4 would be focusing on premium. And this is one that I see, again, way too often because, they, and this isn't even the consumer's fault. Again, a lot of the times you'll hear me complaining and, they'll these companies advertise all kinds of wickedness and just, get you to the cheapest price and this, that, and the third. And they don't really, tell you the truth. They'll say, hey, listen, $13 will get you 150 million bazillion dollars. And they, so I can see why it's smart to focus on premium. Because all they're telling you is pay less for more, pay less for more. But they don't tell you how it works, right? If they just advertise, if Ruth Chris, if the steak industry advertised pay less for more, and then you went to Ruth Chris and you said, hey, Ruth Chris, I see this ultimate hot 500-degree plate with melted butter on its steak that's a filet mignon of Kobe beef. But you want $100 for this steak. I don't want to pay $100 for this Kobe beef steak. I think I can get Kobe beef on a 500-degree plate with melted butter cooked to perfection for cheaper. And then when you go get that steak, it's a McRib. Not even a steak. It's a McDonald's beef patty. Very different in quality. But it's still beef. So, focusing on those premiums. Now, the premium or the cost of life insurance matters to everyone. But if you focus on price alone, you could be putting yourself at risk. While the industry is heavily regulated and has multiple protections in place, policy owners who do business with a cash-strapped or a disreputable company may regret it. The life insurance industry is regulated on the state level, where state insurance commissioners license agents and brokers, monitor products sold within their jurisdiction, and review whether insurers have the resources to meet their financial obligations. Should an insurer falter, all 50 states plus the District of Columbia and Puerto Rico have a guarantee mechanism to help pay the covered insurance obligations of those insurers licensed in the state. To learn more about a state's specific guarantee association and what it covers, you can visit the website for the National Organization of Life and Health Insurance Guarantee Associations, www.nolhga.com. The Insurance Information Institute recommends that consumers perform their own due diligence before they buy. Contact your state insurance department to be sure that the company you are considering buying from is licensed in your state, and inquire as to whether it has many consumer complaints filed against it relative to the number of policies it has sold. I'll give you an example. I have a customer who had a policy with a very reputable company, New York Life. But if you were to speak to this client and see the horror story that he went through with New York Life, you'd realize that even things like the BBB, These huge companies just have so much money that a lot of that stuff gets brushed under the rug, to be honest. But they definitely are doing some things. So for consumers, established company with a solid reputation and a history of meeting their financial obligations are the goal. Real quick trick. When you sit with your financial professional, you can ask them, hey, what's the financial strength of the company? Or better yet, do this. Next time you sit down with your financial professional, your life insurance agent, your financial advisor, ask them for the company's annual report. They have to give it to you. And number 5 is being underinsured. So it takes a big death benefit to replace a family breadwinner's monthly income. If his or her paycheck is suddenly stopped, more than most people realize. Consider a $500,000 term policy, right? It sounds sufficient, but if you earn $50,000 a year, that death benefit would only replace your income for 10 years. Like I tell people, if you make $50,000 a year, the minimum you need is $1 million policy. That's $50,000 a year for 20 years. If you have a kid who's 13 years or under, and you make $50,000 a year, then yeah, you can get a $500,000 policy. But remember, on your health insurance, your child is on your health insurance until they're 24 if they're up to college age. So when you're sitting with that life insurance agent, that financial professional, that financial advisor, you need to tell them, I need you to make sure that you identify and protect my lifestyle, and you protect all the lifestyle that I've put together for the next 20 years. Right? That's your investment strategy. I look at life insurance as an investment in your life. So you need at least a 20-year time horizon. Your average investment strategy is 20 years, according to Warren Buffett, with an average return of 10%, according to Warren Buffett. Therefore, you need, with life insurance, 20 years of your income. So even wealth management clients and high net worth individuals are usually underinsured, says Richard Donald. Again, the reality is, if you want to leave in perpetuity, and here's the real way you set it up. So most people say, hey, there you go, $50,000 a year, 20 years, $1 million policy, I'm set. You're still, believe it or not, underinsured. And as it says here, even wealth management and high net worth individuals are usually underinsured. Even wealth management clients and high net worth individuals are usually underinsured, right? So let's look at the real way that you're going to replace $50,000 a year. Let's look at it like this: a money market account, which would be a high yield savings account, which would be like Goldman Sachs, Marcus Millichap, which gains 0.5% interest or 0.5% a year. So if you get a $1 million life insurance policy and you put it in an account with Goldman Sachs, you're only getting like $5,000 a year off of that. So how do you really get the replacement of $50,000? You get a $10 million life insurance policy on a person who only makes $50,000 a year. Then when that person dies, their children inherit $10 million, and they don't go shopping on shopping sprees and go to Dubai. They come to their financial professional and say, hey, take this $10 million, put in a money market account. Since 0.5% of $10 million happens to be $50,000, you've now replaced your father's income until that money market account no longer exists. Which, if you just leave the $10 million there and it grows at 0.5% a year, it's just going to sit there and you're going to continue to get $50,000 a year until the day you die. To ensure that your family would be able to maintain its current standard of living, you'll need to project your expenses. A financial professional can help. Your policy should not only cover your lost income, but also potentially your mortgage, funeral costs, college tuition for your kids, and any other expense you anticipate, including braces for your son or your daughter's future wedding. While Social Security pension plans, annuities, and other guaranteed sources of income you may have may sustain your surviving spouse in retirement, keep in mind that those funds may not be available to your spouse for many years. Life insurance can potentially help fill the gap until those income streams kick in. If the stay-at-home spouse is prepared to return to work in the event that you pass away, however, it may be sufficient and more cost-effective to purchase a policy that replaces only a portion of your income. As you estimate your life insurance needs, don't forget to include your spouse. A non-working parent who quits work to care for the kids should have a policy as well to cover the cost of childcare or housekeeping services if he or she should die prematurely. I go to many situations where people are like, yeah, my wife doesn't need life insurance. She's a stay-at-home mom. Then she dies and he's like, holy shit, I got to pay for childcare. Because two things happen when a person dies. Not only their income, but their presence. So now, if you're a husband and your wife dies and you're used to running and being the breadwinner, well, now you've got your daughter here. And now you've got to step in the role that your wife played. And now, when you wake up in the morning and your daughter wants pancakes, you can't look at your wife and say, hey, babe, our daughter wants pancakes, because your wife isn't there. So now you have to get up and make those pancakes. So you might have to get up an hour early to make those pancakes, to then make sure to drive your daughter to school so that you can then go to work and do what you need to do. These are real life situations. Now there's a bonus, because some people can be over-insured. Yes, it is possible, and it does happen, Novelli said, particularly to those with fluctuating incomes. By purchasing more coverage than you need, you not only miss the opportunity to save or invest those extra dollars, but you also run the risk of getting in over your head financially and losing your coverage. Young people in particular sometimes buy permanent life insurance based on two incomes, but then they start a family, buy a bigger house, and one spouse quits work to take care of the kids, Novelli explained. Now they're stuck with a policy they can't afford. If you stop paying the required premium on a term life insurance policy, your coverage immediately lapses. With a permanent policy, you have three choices. You can let the policy lapse, stop paying the premium, and access any available cash value, or stop paying the premiums in return for a reduced death benefit and no cash value, according to the Insurance Information Institute. Here again, those with income instability may wish to start with term to maximize their coverage. As their budget allows and their family matures, they may wish to convert to a permanent policy or purchase a separate permanent life policy to meet other financial goals, including estate planning or charitable giving. With such considerations, many people opt to talk with a financial professional. Need advice? Schedule a consult with me. The information is in the description. Indeed, permanent life insurance offers 3 tax advantages. The death benefit to your heirs is paid out income tax free. The cash value that accumulates in the policy grows tax deferred, and policy owners can potentially access their cash value on a tax advantage basis, since the money borrowed or taken from the cash value is not subject to taxes up to the cost basis or the amount paid into the policy through premiums. The most tax-efficient way to leave any type of financial legacy to your heirs is through life insurance. Because when you die and you bequeath your stocks to your next, they have to liquidate those stocks. You can't sell the stocks. Even in a trust, they have to liquidate it. And then those, whatever they sell at the strike price, which is usually the lowest within 6 months of when that person dies, and then you have to pay the executor of the estate and the stockbroker and any taxes. But then your heirs will get that. So life insurance can wear many hats in your long-term financial plan. To make the most of your policy, however, you need to know what you need, when to buy, and which money missteps to avoid. So, ladies and gentlemen, that's the article for today. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. To contribute to channel growth, the information is in the description. Let's see. That's true. You would need more than $1 million, correct? Yeah, most people need more than $1 million. You know, if you're making $15 an hour, $30,000, 20 years of your income would be a $600,000 policy. So I do have a little bit of a bonus for y'all that I wanted to go with. And I think since I'm here, and I've only been going for I've been about a half hour. Salute, Ra. I generally like to go for about an hour. So I think I will go ahead and give you all that bonus. And we'll go ahead and take a look at that today. And this one is going to be, if you're shopping for life insurance, some of the considerations. Okay. So it says, most people buy life insurance when something good happens in their lives, like the purchase of a new home or the birth of a child. These events mean more financial responsibility, and protecting your family with enough life insurance is essential. So what's the best way to go about shopping for life insurance and deciding how much coverage you need? So most people approach the buying process in the same way. It's insurance. I'll probably never need it. I just need to find the least expensive coverage as possible, right? That's what most people do. Now, unfortunately, it's not exactly the best way to do. And they're going to go over some types of considerations here. So, what is the best way to go about shopping for coverage? You know, it's okay to look for low-cost life insurance, of course. But there's important things to consider when deciding what policy, term, or whole, or universal, to name a few, to buy, and how to buy it. So, types of life insurance. To make an informed decision, you must first educate yourself on the various types of life insurance products available. So there's term insurance, right, which gives you a death benefit for a limited number of years, and it's the lowest premiums, and that's why most young people start buying. The most popular policy types are 10 and 20-year term insurance, but they have 5 to 30-year terms available. There's actually a 1-year term life insurance policy too. The policies offer guaranteed level premiums. The longer the coverage period, the higher your premium will be. This is because insurance costs increase as you age, and the insurance company calculates a level premium that will cover the costs over the term. There's also annually renewable term, where the premium covers 1 year of coverage at a time. Like I said, 1-year term. These generally start out with a lower premium than level term, but become far more expensive after only a few years. In general, annually renewable term only makes sense if you're going to need coverage for a short period of time. Beyond term insurance, there are types of permanent life insurance, generally whole life insurance and universal life insurance, offering guaranteed death benefit for life, not just a defined number of years. In addition, permanent life insurance policies can also build cash value, and in some cases, the opportunity to earn dividends, which are not guaranteed. As a general rule, a term life insurance policy offers the most basic coverage at the most affordable price for many people. Indeed, term insurance is usually quite affordable for those who are young and in relatively good health, and is the kind of policy most people start out with. For this reason, the term life insurance market is very competitive. This leads to some pricing tactics shoppers should be aware of. For example, some companies offer very low premiums for super preferred plus applicants, but only a small percentage of applicants actually qualify for that rate. So you may apply for their best rate, go through a medical exam, and a month later, the insurance company offers you coverage, but at a much higher premium rate. Riders and convertibility. So beyond basic price are other factors to consider when shopping for a policy. For instance, there are some additional benefits, often referred to as riders, that you may want to add to your policy. So riders are like aftermarket parts, or not even aftermarket parts. They're like upgrades or bells and whistles when you're purchasing a car, right? So if I go to the car dealership and I buy a base model car, right, and I have to crank my windows down by hand, well, if I say, hey, I want to add the power windows so I could just press the button and roll up my windows or roll down my windows, that would be the equivalent of a rider in your life insurance policy. So that car that started at $39,000, when I had to crank my windows, right, and that Mercedes-Benz that started at $39,000 because I had to crank the windows, well, now that I add the power windows, it's going to be $42,000 for that same Mercedes-Benz. So when somebody says, how much is a $100,000 life insurance policy? Well, it depends. Are you getting riders? What riders are you getting? Are you just getting the base model where you have to crank the windows? There's no nothing special. There's no bumpers. There's no center console. You don't have the light up in your display. You see, those things matter. Now it makes a whole lot. Oh, it's not just life insurance anymore, right? It's something different. It's an additional item. So there are riders that you may want to add to your policy. One is the disability waiver of premium. This benefits waives your premium and keeps your life insurance in force if you were to become disabled and unable to work. I see this all too often, especially with a term policy. Somebody gets injured, they can't go back to work. Well, if you can't go back to work, you can't pay your premium, especially when you buy term and invest the rest. See, term insurance, if you miss one payment, that's it, your policy's canceled. There's no grace period or nothing. So look closely at this rider when shopping, because some companies offer very competitive basic policy rates, but their rates for benefits like a waiver may not be that competitive. Another feature you may want to consider when buying a term policy with an option to convert the coverage to permanent life insurance at a later date. Many policies offer some type of conversion option, but you should consider which permanent policies you can convert to and how many years you have to decide if you want to convert. Some companies limit the policies you can convert to and exclude their most competitive products, or they have very short conversion periods. Convertibility is important for a couple of reasons. First, term life insurance only provides coverage for a limited amount of time. Your coverage may run out when you still need life insurance. When that happens, you may decide to get a new term insurance policy, but you'll be older, so your premiums will be higher. And this is my main issue when people tell you to buy term and invest the difference, and they're saying that that's a financial plan, because that's a very foolish financial plan. What they're explaining to you is that your financial plan is to die in 19 years. If you sit down with somebody who's 20 years old and you say, hey, you're 20, buy term and invest the difference. Most people don't invest the difference in an equally risky investment or an equally safe investment. And they also don't take that time horizon. You're telling this person, hey, buy this term insurance in case you die along the way. And hey, don't worry about it because you're planning on dying at 39, Mr. 20-year-old, because your financial plan is to invest the difference. And, these investments, well, they're not liquidatable. You can't liquidate them in 72 hours. So if you die after 20 years, if you die on year 20, well, the policy is lapsed. So there you go. In addition, if you've developed any health issues, you may not be able to get coverage at an affordable price. Converting some or all of your term insurance to permanent coverage can help ensure that you have the coverage that you can keep for as long as you need. In fact, it may make sense for you to buy some permanent life insurance while you are young, just because it's far more expensive when you get older. Another reason that a conversion option is important is if you were to become disabled. If you're permanently disabled and you have a waiver of premium on your policy, you can convert your term policy to permanent coverage, and with many companies, the premium for the permanent coverage will be waived. Another thing to consider is the quality of the company you're buying your policy from. Reliable life insurance companies are generally rated on the financial strength by several rating agencies. These include AM Best, Moody's Investor Services, Fitch Ratings, and Standard & Poor's. Financial strength ratings are a key indicator of a company's ability to meet its financial obligations. Look for a company that has solid ratings. You might also consider how policy owners and beneficiaries rate their service. Many good companies have some type of customer service ratings or awards. So how to buy life insurance? Then there's the question of how to buy your policy. There are a number of outlets for term insurance when you can buy online, and many people do. However, it may make sense to buy your policy from an experienced financial professional. Yes, those selling insurance usually do get paid on commission, but the policies they offer are in many cases the same ones you will find online. So typically, you won't pay more for going through an agent. And there can be some advantages. First, a financial professional can help you determine how much coverage you really need. And that may be the most important decision you make. Many people try to make an educated guess, and many companies, including Mass Mutual, offer online calculators to help you gauge your approximate needs. But actual life circumstances and financial needs vary from individual to individual and can call for a more refined and established method of determining what type of insurance and how much coverage is needed. A financial professional can help you make that determination. In addition, an experienced life insurance agent can also recommend a policy that is the best fit for you based on your age and financial goals. They also know the companies and policies they sell and can answer all your questions. If they're a broker like myself, they can shop for the best rates and help you through the underwriting process. Buying life insurance is an important financial decision, and that's why it is important to get the right amount and type of coverage to protect the financial security of the people that depend on you every single day. So, ladies and gentlemen, that's the bonus article. Salute going on. What's going on, Sir Anthony? So, that's going to be it for the article for today. I just realized I didn't even post this one or share this one with y'all. I was just reading it. But it's still important to see. So, that's going to be it for today. Ladies and gentlemen, make sure you drop a comment, hit that like, subscribe, and hit the notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, if you'd like to contribute to channel growth, the information is in the description. If you'd like to schedule a one-on-one consult with a licensed financial professional, my information is in the description. If you'd like to purchase life insurance directly up to $1 million with no medical exam and an instant decision, the information is in the description. With that being said, ladies and gentlemen, wipe ass, work in progress every day, and see success. Wipe in progress, wipe ass. You know what? I got another 10 minutes. I actually got one I want to read, which is another article. And it's talking about working with a financial professional, if you should go solo or if you should do it with a financial professional. Actually, yeah, let me share that one because I don't want to stop yet. I'm kind of in the groove. I do need to go to the grocery store, so this is going to be the last article. But this one is actually very important as well because it says why working with a financial professional may be better than going at it alone. So, this is another article from Mass Mutual. If you're looking to improve your financial situation, Whether that means saving more now, investing more for the future, or gaining more flexibility along the way, you do have a few choices. You can do it yourself, navigating the complexities of investments or insurance on your own. You can ask a friend or family member, probably the one who's always been good with money. Or you can work with a trained financial professional you can rely on to provide specific advice for your unique situation. The first two options will obviously cost less. Financial professionals do charge for their time and advice. How much they charge depends on the type of professional you choose for your particular situation. But, like many things in life, what may seem like a frugal step now could end up costing you more in time and effort down the road. There's strength in working with others, especially those whose training and experience is directly suitable to the task at hand. Here's some reasons why connecting with a financial professional can work out well. Distilling the information overload. You don't have to look far for financial information. Just turn on the TV or open your internet browser. Go to your Facebook. Everybody's a crypto guru now. You'll hear media pundits talk about budgeting. You'll see financial gurus elevate buzzworthy stocks. You'll read in-depth blog posts about the pros and cons of life insurance. Here's the problem. There's no one-size-fits-all solution. What works for some may not work for others. So unless the advice is personalized to you, it's just a lot of noise. And that noise can sometimes be deafening. A financial professional can help you distill all the information, black out any noise, and then provide guidance tailored to your finances, your family, and your goals. Getting to know all about you. To help design your financial roadmap, financial professionals will first get to know you. There are many factors to consider, from your age and your health to your job and your family life, from debts and taxes to savings and investments, from your goals and dreams to what's keeping you up at night. It all ties together. Only then can a financial professional help you to develop a comprehensive, personalized strategy. After all, a good financial strategy considers everything. Leveraging professional experience. Most people don't have enough time in the day to do laundry, let alone to do the due diligence needed for all their financial decisions. That's why using a financial professional can be so advantageous. A financial professional's job is to keep up with the financial times, paying attention to market conditions and to changes in tax law. Financial professionals frequently attend training courses and seminars. They learn about all changing state and federal regulatory laws. They stay up to date on all the latest products and offerings, which change just about every day. If a new opportunity arises, a good financial professional will know about it, and more importantly, know if it can help you. Taking the long view. Working with a financial professional is a long-term relationship founded on trust, understanding, and patience. Remember, building a nest egg takes time. This long view is one reason why a steady investment strategy makes sense. Knowing that you have a partner by your side every step of the way is a huge advantage. Yeah, he said, this is very important to remember. Yeah, everybody, don't leave. I'm staying a little bit longer because I think it's important for this to tie right into working to a financial professional. I think at least an hour is how long my lives need to be. So, your professional is always looking for the financial solutions to fit your current situation, all while managing your risks. So when life changes, your professional is ready to help you make the right financial decisions to change with it. On the flip side, advice you'll find on the internet tends to be reactionary and nearsighted. The latest trends rocket to the top of the feed, only to be replaced quickly by something else. Meanwhile, online and TV personalities typically have competing agendas, And sometimes that can simply be improving their ratings or selling their latest book. Dave Ramsey sues Orman. Dave Ramsey sues Orman bullshit. Excuse me. Now, so while every client relationship is different, you should anticipate working closely together, meeting at least once a year to reevaluate goals and staying in touch via phone or email to ensure you're staying on track. So yeah, like I said, a lot of those TV and radio personalities, they'll tell you shit like, buy term and invest the rest. Don't work with a financial professional. Don't buy whole life insurance. Dave Ramsey sues Orman. But Dave Ramsey won't tell you that his largest holding is a cash value life insurance policy. I'll give you another one that's a very swift trend. I was on Facebook the other day and I got into an argument with someone. He had the nerve to call me a weirdo because he was going crazy over crypto.com spending $700 million to put their name on the Staples Center. And he was like, yo, I told y'all, man, crypto's the wave. Look, they're getting the arena. I said, well, that's bullshit. Nobody is going crazy over Amway, and Amway owns a stadium, the Orlando Magic Stadium. And then I said, what's worse is you're going crazy over one stadium being purchased by crypto.com for $700 million. But nobody's going crazy clamoring, hey, y'all need to buy that life insurance. Y'all need to buy that life insurance. Did you forget about MetLife Stadium, which was $1.9 billion? MetLife Stadium. Nobody said, hey, get life insurance. MetLife Stadium spent $1.9 billion. And there are 12 sports arenas owned by life insurance companies. Yet nobody is clamoring to buy life insurance like they are getting into crypto because crypto.com spent $700 million. See, it's on the internet and it's a nice trend, but as an actual financial professional, I have to remain cool, calm, and collected. You're not a financial professional, and that's okay. Chances are you don't have a degree in finance or economics. You probably don't have any professional certifications or accreditations in financial services. The initials after your name are more likely to be junior or the third than CFP or CIIA or CLFC or CHFC or WMCP. Most people are not financial professionals or money professionals, of course. Yet those who are in that profession not only have the right qualifications and credentials, have your financial goals in mind. When you work with a financial professional, you'll have an advocate in your corner, someone who understands your unique financial needs and family situation, and how to tailor a solution around both. That is a very good thing. So now I'm going to go ahead and stop, ladies and gentlemen. But like I said, this is what it's really, really all about. You know, working with that licensed financial professional. It's very funny. I go to the hood and I give my card to people. I say I'm a licensed financial professional, and most of these fuckers have no fucking clue what I do. What do you do? Nigga, I'm a licensed financial professional. I'm a financial advisor. Well, what does that mean? What do you do? Insurance and investments, motherfucker. Unlike your best friend who's a fake-ass crypto guru. But anyway, ladies and gentlemen, make sure that you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, if you'd like to contribute to channel growth, my information is in the description. If you'd like to purchase life insurance up to $1 million with no medical exam and an instant decision, the information is in the description. If you'd like to schedule a consult with a licensed financial professional, the information is in the description. With that being said, he said, so basically, folks paying for the financial expertise of your financial advisors can save you a lot of pain in the future. Either pay in the front end or pay in the back end. And that's actual factual. So with that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.